Hi everyone, Sanjeev here. Today I have a very special guest who is not only a successful property investor but also a property tax and finance strategist. In this episode, we're going to discuss the state of Australian economy in general to start with, and then our favorite topic of impact of inflation and rising rate of interest to current property market. So let's get into this episode. Welcome, Amit. How-
Thanks, Sanjeev. How are you?
Good, good. Good to have you again on our show, Amit.
Thanks for inviting us again, second time, huh? In 3 months.
Thanks for your time again, Amit. So I think as we discussed, I think it'll be good to listen from you. The current state of Australian economy, and then we talk about that, and then we can get into our favorite topic of inflation and
Absolutely. The hot topic of inflation and interest rates,
yeah,
huh?
and what
Yeah, yeah.
the property investors should be doing to have the less impact, and if they can see the opportunities across the inflation and the rising rate of interest.
I think if we look at Australian economy, there is a lot of media coverage on different things, including interest rates for that reason, right? But the good news doesn't come out as often as it should. I mean, I was looking at Austrade figures. They were saying we are 0.3% of the world's population and we contribute 1.7% to the global economy. And the other important thing that I looked at, we are number 13 at the moment in terms of the largest economies in the world. And we're anticipated in 2023 to be 12th largest economy in the world. Looking at the size of population we have, that's pretty significant in that sense. Um, and one of the biggest stories that hasn't been getting much attention in media because of I personally feel negative news sells a lot more than the positive news is. They haven't been talking a lot about balance of trade, which is a net of export and import. So if the balance of trade is positive, we are exporting more and importing less. If the balance of trade is negative, we are importing more and exporting less. Australia is a net exporter in general. And I was looking at statistics published by Australian Bureau of Statistics. Till November, they have given us data. December data is yet to come out, December 2022. So 12 months from till November 2022, the net of trade is $134 billion in 12 months,
What does it mean?
which means we have exported goods less the imports. That surplus is $134 billion. This is net of after we have exported and what we have imported.
134 billion.
Dollars in 12 months, starting December 21 to November 22. Now, if we go back 4 years, it was only $15 billion.
So that's what,
When
like
you look, almost 8 times,
from 15 to, okay,
nine
nine
times.
times.
It's 9 times the growth in 4 years. And this is despite the fact over the last 3 years, our biggest trade partner has imposed massive restrictions in importing Australian goods into their
And what
territory.
has happened? Like suddenly, how come, like in 4 years, massive nine times of export happening? What are these things? What we are exporting actually?
So obviously we are predominantly mining and resource country, right? That's where our fundamental, that's the backbone of our economy, if you want to look at it. Now, the war in Russia and Ukraine has definitely fueled our growth big time, but restrictions from China meant that we are looking at other opportunities. For argument's sake, I was looking at cotton. Typically, we'll export $1 to $2 billion worth of cotton to China before the restrictions were imposed. Last 12 months, we have exported over $8 billion worth of cotton, and nothing has gone to China. It's all going to Vietnam for that reason.
So the whole
Right.
the export.
Balance of we were so reliant on China and Japan before, but now with these restrictions, I almost take it as blessing in disguise, to be honest. Where we have been forced to look at beyond our comfort zone as a nation and explore opportunities which exist somewhere else, which were already there, but we never looked at exploring them.
And that itself has become like four times, I think, from 1 to 2 billion to 8 billion, did you say? Just for the cotton, right?
Just for the cotton. I mean, it's a very small portion. Obviously, we are exporting a lot of energy to Europe and other things coming through, But that's one aspect which hasn't been spoken about in our economy in general. What that means for us, So there is $134 billion that have come into Australia one way or the other. There's 26 plus million people. A lot of that would filter through to common people in terms of people are able to negotiate better pays. Businesses have more opportunity to grow and develop. And the government is one of the biggest beneficiaries out of this, where they are investing in projects. And almost 4 months ago, the government realigned they said over the next 4 years, they would earn an extra $100 billion in taxes. I can't remember the exact number, but there was a number put out. They have revised their tax collection by over $100 billion over the next 4 years. So there's big story that has gone missing or hasn't got as much attention. It has been covered a lot by what's happening in the interest rates and inflation market.
I mean, I can see, like, say, as you said, like 4 years ago, export was 15 billion, and now we have got 134 billion, right? Just last year. Now,
Trade
that
surplus, yeah.
some business or some sector is making that money, and I'm sure they have to pay tax.
Correct. Predominantly, we can look at mining and farming is the other sectors that are making that money. Now, they employ a big chunk of our population, right? Those people get better pays. The businesses make profits. I mean, a couple of months ago, big mining companies, 2 or 3 of them declared dividends to the tune of $18 billion in 1 week. Now, that is predominantly driven by this growth that has come through the exports we are doing.
And are these growth sustainable? Like, do we see the longevity of these, or it's like a one-off, 1 year, 2 year growth happening?
Good question. Now, some of it would be sustainable, but it will come back as well, because I think whilst what is happening with the war, a lot of people have been, a lot of countries, including predominantly Europe, has been forced to look at alternatives for their energy resources, right? Once new channels are set up, I don't believe they will go away completely. They might come to claw back a little bit, but some of this growth would be sustained, but some of it will go away.
So I think from that perspective, and especially, I think, as you said, mining, farming was another one. Now, mining, what if you see like it's gonna be a bit of a long term this time, or like a lot of
Mining,
lithium, uranium. I mean, not uranium. I think lithium and all we're talking about, right?
yeah, the uranium is definitely a big part of our exports as well. It's not as big as coal and lithium is getting a lot of noise. It's a lot in news because of the solar, sorry, the electric vehicles, but coal is our fundamental export. That is the core, and then gas, and then lithium, uranium, name a thing we don't export. We export a lot of mining stuff. I think with opening up of Europe and even India, they had a trade agreement which came into effect as of 1st of Jan. I don't know the details, but apparently there is agreement that will open up trade avenues with India as well. Opening up of Vietnam and all those economies. I think it will be good. We are in good space for next few years. How that pans up from there, we'll see. But at least until the effect of war is gone, this will be sustained the way we are. If anything, it'll go up in coming months. But then eventually, once the war is gone, everything is settled, then probably we'll see some degree of clawback because there would be some negotiations going on, some normalization of relationships would happen as Australia is trying to do with China right now, so we can open up trade with them as well. So those adjustments would happen with time, but I think we will retain a big chunk of this in next 10 years for that reason, I believe.
So if I say, in a summary, like we are, next decade or like at least 5 to 7 years time, we are looking as a good in our Australian economy in terms of the numbers and the growth, and the profitability as a country.
Certainly, I think there is a good story that is coming out of this, even though it is coming on the back of bad news, which is a war. But I think for Australian economy, it is a positive sign. And I mean, there has been a lot of news going around that one third of the world countries would go into recession in coming months and years. I don't believe we will have hard landing. We might get some of the sniffs from around the world because we typically react to anything that happens in US. But other than that, I don't believe we should get a recession. At least I personally don't think we will get a recession.
What we are seeing, the all the indicators are, are contributing, saying that, actually we are safe, right? So I think, so makes sense, Amit, and no, thanks for sharing that. Now, economy wise, we feel like, we are comfortable, we are good, from that perspective. Now, how does it, relate to our, inflation and the rising rate of interest and eventually the property market? So what do you have to say on that?
Okay, now, as much as this is a good story, it's not so good for inflation and subsequently for interest rates. What that means is when that sort of money is flowing into economy, it gives buyers a lot more power to spend money. What that means is, even if a dollar thing is costing you $1.10, you still have some capability to buy those things. It's not dropping off straight away. So inflation, RBA has been trying to control big time with interest rate rises from zero point 0.1 to 3.1% in less than 12 months. Almost in 12 months, they've done that.
Now, Amit,
So,
so sorry to interrupt here. Like, do you want to explain what exactly inflation mean? I know this terminology creates a lot of confusion with a lot
sure.
of people. So, can we start with that
So,
explanation?
so very fundamentally, if you went out to buy something 12 months ago and you were able to buy it for $100 and you go out to buy that thing today, it will cost you 107 to $108. So that change in price for same unit thing is called inflation. So it's costing you $7 or $8 more to buy same thing as you paid for it 12 months ago.
And what is the reason behind?
All these factors, so people's affordability is a reason. What is happening? Supply chain is an issue. Lack of manufacturing over the last few years. All those things come into play to increase the cost of the goods.
More consumer demand.
More less supply than demand, basically. Fundamentally, that's where it sits. You understand that rationale from property, but the demand is more. Why is demand more? Because the supply hasn't been able to meet first demand and the next demand comes along and then there's backlog on demand, but the supply has been disrupted due to various factors over a period of time. So what does that mean for us in 2023? I've been thinking about how inflation is going to play out in 2023. I think interest rates are already on a higher end of spectrum. Australia has opened up borders, which means there would be more resources available coming down the track. I'm hoping in 6 months' time, there'll be additional 30, 40, 50,000 people coming into country who can straight away jump into, getting into workforce and starting delivering, which will ease off pressure on salary and wage and hence inflation subsequently. Same thing, I personally believe the supply chain issues are getting resolved, and that will reduce the pressures on upward pressures on pricing. All those three factors would help us contain inflation. While there are already signs that it's sustaining around 7%. Hopefully, from here we see a drop, which we should in next 3 to 6 months. I do anticipate inflation would go down, which means that RBA would stop increasing interest rates in coming months.
Okay. So for the people who are listening, actually, we're recording this is in early February 2023. So just for the context, yeah.
Yeah, I think that will play a big part in terms of curbing inflation. At least I believe. I'm sure there are other aspects which can be looked at, but these are the three big things I believe will play major role in reducing the inflation over coming months.
Okay. Um, Now, with all this, rate of interest rates going up, what are some of the key things investor can or should look into it or can do to still
Yeah.
manage the risk or is still able to buy properties if they're still have got the borrowing and the cash available. So, what are some of the things you'd highlight?
Our interest rate story has been extremely interesting over last few months. In fact, few years. We went from, if we go back 7, 10, 15 years ago, 4, 5, 6% used to be norm, and anybody getting close to that was a good bargain. Then we came to a point where two became the norm for a very short period of time. And anybody who entered the market at that point in time thought that was the norm. No, that wasn't the norm. What you are looking at is the norm, is that interest rates went from 5, 4, 3, 2, and then now they have come back. Now the pace at which they came back was astounding. That's something we were not ready for. So it went from 0.1% to 3.1% currently, and RBA is due for a meeting on 7th of Feb to revisit whether they want to increase interest rates or not. I personally think they should hold on, sit tight with what they've done and wait for it to play out. Typically, it takes 6 to 9 months for a rate rise to play its part in the economy and see how people react to it. They've done enough of rate rises over the last 12 months, but we'll see what happens. They won't listen to me. They will do what they want to do. I'm not one of their economists they will listen to. So yeah, hopefully they don't, but most likely they will. Now, having said that, I think next big thing that we need to look at is where to from here in 2023. I guess that's the big question in terms of interest rates and what, like you asked, what can investors do to manage their situation. On upper end of spectrum, I believe we shouldn't see anything more than 0.5% of interest rate rises. Considering where we are, the way inflation is playing out, unless some other factor come into equation and start playing its role, I don't believe it should go up any more than 0.5% in next 3 to 6 months at the max. Currently, owner-occupied properties are paying interest rates of around 4.5 to 5%, and investors are paying 4.75 to 5.5% in that range. If you are not in sync with that range, then you need to look at what's the case. It's really case by case. That's a very broad spectrum I'm giving you. That's there.
Yeah, and
Right?
it depends, depending on a lot of factors, income. So yeah, that makes sense.
that interest rate rise of 0.5 could be very significant for a lot of people. Already people are feeling the pinch, those who are on variable. Now, if we break down people into two categories, interest rates. One, there were people who were fixed interest rates a year ago or 2 years ago. And the other ones who have bought more recently or are on variable rates for different reasons, So this is how we are analyzing our existing portfolio of clients when we are talking to them. We're saying if you are on a fixed rate and it's coming off in October, November, December, or Jan, Feb next year, play hardball with yourself. Start building buffer right now. Assume that you are on that higher interest rate and start building buffers for that. So you don't have hard landing when it straightway jumps from 2 to 5.
And what are some of the things people can do to build that buffer?
Sure. Now, if you are on fixed, of course, the first and foremost thing is looking at the amount of money you're making and how you can save. So that's your first and foremost thing. Can you put some money aside in that sense and leave it untouched? So when the interest rate goes up, you have some sort of comfort that you are not flying blind, relying on your income at that point to save you. Budgeting is the first thing that comes to my mind, right? And if that's not helping, then there is, I did a list of occupations once that you could do along with your primary occupation, right? So for argument's sake, Uber driving, teaching, online teaching, I've got a client who does a day job, and over the weekends, he goes in for 3 or 4 hours, help old age people to do their shopping, and he gets paid for it. The government pays for it, right? So there's ample of opportunities for people to do different things to build their buffers. Leaving it till October, November, and then saying, what should we do, will be too late. So should look at building those buffers one way or the other. Second class of the people is who are on variable rates right now. Now, if you are on variable rate, you must look at, like I said, the interest rates for owner-occ is between 4.5 to 5, and investor rates are 4.75 to 5.5%. If you are not sitting somewhere in that range, you definitely need to look at why. So you need to look at better rates. The lenders are negotiating big time better rates for sure. So you need to look at making sure that your interest rates are in sync with market. Now, the other thing that has happened over the last 2-3 years is there was a significant growth in people's asset values. So if you bought property 5 years ago for $500,000, it's easy, probably, it could be $700,000 for you. Now, your loan 5 years ago was $400,000 if you borrowed 80%. Now it might be 380. Now, that means your loan to value ratio has gone down significantly. What that means is you can go back to your lenders, revalue your property, and get a lower LVR for you, which means so typically I've seen over the last 12 months, a lot of lenders have started offering products based on the loan to value ratio. So if you are 60% LVR asking, then you might get 4.5%. If you're looking for 90%, you might end up paying 5% interest rate.
So are you saying, Amit, like just making a call to the bank and saying, hey, can you do another valuation for me, and then see what my LVR is, and then put me in that category of rate of interest, which is lower than when we started a year or 2 year ago?
Yeah, you can do that. You can definitely ring your bank and do that. I've got a lot of clients. We are reviewing at least 3 to 4 every week for our existing clients, making sure their LVR is in sync with what their property is worth, and the interest rates reflect that as well.
Yeah, makes sense. Or like, of course, definitely call your mortgage broker, whoever you're using, so that they can approach the bank and do the work for you. So, okay.
Correct.
Yeah.
So this is where, you better working with your team rather than, you can ring the bank directly as well. They will talk to you. There's no issues around it.
Yeah.
Definitely. either approach is fine. There's nothing wrong with it.
Yeah, I think, and the similar thing
So
can apply to the owner occupied also, right? Like if you're in a higher rate of
correct,
interest, and then of course the
correct.
LVR.
Any property you own, you believe it has gone up in value, you should um, look at revaluing it with the same lender and request them to reduce the interest rates. If they're saying no, then
Mm,
you should look at moving somewhere else. You should keep your options open. You are business for bank, and that's how they look at it. It's a transaction for them, and you should not be paying any loyalty taxes for that reason.
yeah. I think what
No matter
what
which
what
bank
I'm
it is.
learning the key here is to do evaluation, because sometimes you
Yep,
just randomly I've seen people calling the bank and saying, "Hey, the other banks are offering this rate of interest. Can you do?" And they say, "We'll see," or maybe, or no, they drop you by 0.1. But I think here, if
yep,
you do evaluation and if the property price has gone up,
yep,
because in the current
yep,
market, I know banks are looking at, if you have a lower LVR, they are willing to pay you a better deal in terms of the rate of
correct.
interest. So I think that makes sense, right? Like, so the key here is make sure
Absolutely.
whoever is listening. I think we're talking about ordering evaluation. Either you call your mortgage broker or your bank directly. But yeah, ordering evaluation is the key here.
Yep, yep. Just saying my property value has gone up significantly and my loan to value ratio has dropped. So I need to look at what better rate can I get. If you go to any lender's website, it will show you that if you are borrowing 70%, the interest rate is X. If you're borrowing 80%, it's a bit higher. If you're borrowing 90%, it's a lot higher. Yeah. So depending on where you sit, you can get significant deal, which means it will help you manage your cash flows when the interest rates are very high. You know, the key is to understand where are you at right now, what action do you need to take to mitigate the change in market circumstances. You know, the other sorry, go ahead.
So I was saying, like, now you said two things. One is, of course, you can do some extra saving, look for extra income avenues. Another is like, do the valuation, ask for a better rate of interest. What are some other things people can do, Amit?
The next step in this process could be, is look at first understand what it will mean in terms of the new repayments. If you're coming off fixed, the new variable rate, what it would mean in terms of costing you money, and whether you can afford it or not. If you can afford it, that's fine. If you can't, then the next two options could be something you want to look at, which is, there's something called interest-only loans. You know, if you, for argument's sake, obviously the term explains itself, so you will be paying interest only without any principal. Now, typically, banks are okay with investor loans to go on interest only as compared to owner, but they still offer the product on owner as well, where they will let you have interest only period for certain period. Now, let us assume if you go on interest only for 2 years, so that will help you manage your cash flow while these uncertainties around interest rates are floating and the inflation is high. I did an example, whilst I was working on my things, where if you have a $400,000 loan on P&I at 5%, it will cost you around about $2,600 per month, depending on the loan term left. Interest only loan could be around about $2,100, which means you have $500 cash flow saving on a monthly basis. And now my numbers are based on certain assumptions. So I'm just giving you an example that it could mean that there is extra $500 per month for you to manage your cash flow in that sense.
True, true. And again, the point here is like, that do that now, while, not in the last minute in October or November when your fixed period is finishing, so
Correct.
that you know I mean or start the I mean, of course,
At least be
be
aware of
aware
it.
of.
Be
Yeah.
aware of it. Understand your position and make informed decisions from there. For getting to know your position is important in this whole situation, and then taking it from there. Uh, with interest only loans, bring to attention two things. A, interest only loans are typically a bit more expensive as compared to principal and interest loans. For argument's sake, if you're paying 5%, you might end up paying 5.5% instead of 5. Second thing that you need to be aware of it is with principal and interest loans is uh, you will, if your loan term is 25 years left and you ask for 2 years of interest only loans, that means you have to repay your principal in 23 years, which means your P&I repayment will go up for those 23 years. So there is a trade-off. There is a consequence if, and you need to, the only thing it will allow you to do is to understand your position. It'll give you more time to put things in motion. So in 2 years' time, when interest only period comes off, you are ready to deal with the next phase of your uh, home loans.
Amit, now a point here, like you said, like, if you're taking a 2-year fixed, interest only loan, then you're left with 23 years in our example of 25, right? Now, that is only if I remain to the same bank. If I refinance and move to another lender, then can I get another 25 or 30-year loan, or how it works there?
Correct. So that's another thing you can look at when you are evaluating your position. So which is refinancing for longer term. So let us assume if you have um, you, you bought a property 10 years ago, you borrowed it for 30 years term, 20 is still left, 10 is gone, right? Now with this uncertainty coming around, you can refinance to another lender with 30-year term again, yet again. Though it is not ideal if you want to pay off the home loan, but it is an option for you to look at. Now, for argument's sake, if you just with the term, if you got $400,000 loan with 5% interest rate on 20 years left, you're paying $2,600. With a 25-year term, that repayment would be $2,300. So it'll give you that breathing space of $300 every month, give or take, um, from cash flow management
True. Yeah,
perspective.
exactly.
But
And we're talking about, say, like, not a big promoter of going interest only, but then, in this kind of where interest rate is going like crazy, increasing every month, just how do you're
yep,
looking for, different ways of how to manage the cash flow by doing
yep,
simplifying, because it's not a long term proposition even we're talking, but like in short term,
yep,
what can you do just to get away of this rising rate of interest pinch, right?
yep. I think more so what we are discussing is about the uncertainty that has come around and the pace at which this has been brought upon people. They've been caught up. So nobody was anticipating the interest rates, RBA increasing interest rates from point 0.1 to 3.1 in less than, span of 12 months. So it's gone up 30 times. I mean, if you look at it, that's scary, but it's gone up significantly over 12 months or so. And it's the uncertainty is still not over yet. There is still some lingering on news coming out of different banks and RBA and so forth, which are indicating they could possibly be few more interest rate rises. So this all what we are talking about is managing the uncertainty in the equation. Where the final interest rate settle down, you have to accept that as norm and work with that. 0.5% below and 0.5% above should be your range, and you should be able to manage that as and when it happens.
Yeah, true. I think, say, I'll add onto, as another option, what I've done personally as my property portfolio has now grown up. So I've taken out now some of the equity from the property and keep it as a buffer, and having money in the bank account gives me extra peace of mind. Hey, while I may not use it, but that's give me
Yep.
extra peace of mind that I've got the money sitting. So
Yep.
that way, while I can do all those things, interest only and whatever option you give it, right? But then I'm doing that as well because of, with as your property portfolio grows, probably you need but little bit more cash, just to manage that rising rate of interest.
So one of the things that we encourage our clients who are becoming property owners and then investors is add 3 to 6 months worth of buffer on their expenses. Minimum 3 months, 6 months is better. But if your comfort zone allows more, requests more, requires more, then go for higher buffers. Every single time our client buys investment property, we highly recommend they should have 10 to 15 grand extra buffer uh, added to their savings to make sure if the property breaks down, for argument's sake, I bought a property, in Perth a few months ago, and within first week of ownership, aircon breakdown. So we had to negotiate that. We have to replace that, and there were a couple of other things that came along, which we had to work on. So there was 5 grand bill that was coming our way. So had we not got that buffer, it could have been a train smash for our household everyday living expenses. Investment should be treated just like another business, and you need to put measures in place to make sure that there is you're covered for rainy day.
Yeah, so true. Yeah. Yeah, I think I feel like, as a property investor, all you're doing is, you're a manager of your own portfolio, and you're just managing the cash flow, managing it well, having a good property manager. So the property looked after, have a good tenant. But then at the end of
Yeah,
the day, you're managing cash flow just to, well, no, the
yeah.
property appreciate in value.
I think in next 12 to 18 months, cash flow would be critical for a lot of people purely because they have been caught by this storm of interest rate rises and which hasn't passed yet completely. And that pretty much driving a lot of degree of anxiety in people. So if you are aware when your fixed rates is coming off, if you are aware when your variable rates is gonna, what's your variable rate, whether it's in sync with the market, if you are aware you want to go on interest only loans or refinance for longer term or take equity out from your existing home. These are 5 steps you can take with your existing portfolio to make sure that there is some degree of comfort when you are managing your portfolio. And in all honesty, you should be doing this on regular basis anyway to make sure that your property portfolio management is robust. It's not getting stale, sitting there. Interest rate is 6%. I mean, I was talking to one of my clients after I did their this year's tax return when they came to me first time. This is 3 years ago when they came to me. Their investment rate was 5.5% while market was at 2%. And when I looked at the numbers after doing their tax return, there was $15,000 interest saving with a portfolio of less than $800,000 in there. 15 grand is a lot of money not to let it go. So you got to be aware of those things and not to let it slide anyway. At least once a year, you should do that health check on your property portfolio. Make sure you understand where it is.
Yeah, and this is, it's a good reminder also. This example was just you shared, Amit. Like there's so many smaller things in the property. Like you don't have to do major or big things. Just
Correct.
looking, putting on a spreadsheet or, however you manage it, looking at on a regular basis and say, okay, oh, can I do this a small thing, and it makes a lot of difference. Which can help you just manage it so well. So now, no, thanks for all the tips, Amit, on this. I'm sure it will help to a lot of the people listening, and they can go look back at their property portfolio, either it's one property or 10, doesn't matter, and
Yep.
then they can tweak it. Um, Now, what's happening on the property front, like with the rate of rise, people thinking property prices are going down, and all those, especially listening in the media. So what do you have to say? Like, what's happening?
Look, I think, like I said before, there's been a lot of uncertainty with interest rate rising, inflation, and the commentary in media doesn't help. And every single year, start of this year, the media was like, this year the property is going to crash by 15%. If I'm not wrong, you can correct me. I think the best case scenario is 7% overall. I'm saying, it's not even half of what they said. Now this year they're saying it's gonna again. I've been hearing 10, 15, 20% corrections. Those figures are floating around. Now I'm about to make a brave statement here, but I think if nothing, the property market would go up 4 to 5% this year. Why? Let's break it down a little bit. Right now, the interest rates we are saying they're going to go up. Yeah. Whilst, yes, there would be some increase in interest rates, the other aspect of it is that will reduce the inflation. There are more people coming in the workforce. There is more certainty around supply chain as we go along. I think in next 6 months, those things should play out, and there would be a reasonable ground to believe where we would be in 6 months' time. That's where it will sustain. It should sustain there. There will be reasonable indicators, I believe, at that point in time, that it will sustain at the levels it will be at that point in time. Now, I personally believe there are a lot of people who are ready to go into the property market, but because of all the noise and uncertainty, they're sitting on the side waiting for this uncertainty to go so they can start doing what they want to do, which is look for their first property investment or whatever it is, wherever they are on their journey. A lot of people have put a pause button to their journey for now. That comes with that will go away as we get clarity, and a lot of people would jump back into the market as we go along towards the later half of the year, or maybe even early 2024. Now, also, I want to bring this to equation as well. Whilst a lot of people are sitting on the edge thinking they will do it once they get clarity, one thing that you end up losing when there are a lot of people in the market is opportunity to negotiate. I know a couple of my clients in Sydney Metro, they have bought their owner-occupied properties. They've been able to negotiate good 5, 7, 8% on the purchase advertised price in Sydney. We are negotiating something
Yeah,
in Melbourne
yeah,
as
you're a
well,
good
where,
example, I think. Yeah, you just now
yeah.
you're
So,
negotiating. Yeah.
yeah, we are in the middle of negotiations. I can't disclose the details just yet. It's early days. But we have been able to negotiate 6, 7% right now from the advertised
And
price.
this is in a very well-established tight pocket,
Correct.
right? And
Correct.
it's not like you have plenty of options, but it's still you
Yep.
have got because of
There are 5 properties in that suburb that are advertised. If there are 5 properties advertised right now and I'm able to negotiate a price, which is a lot lower than what they want for it, that means any issues that I will face or any disadvantage I would have out of higher interest rates has been compensated to some degree here, or in fact, more than some degree
maybe
here.
for another 2 3 years already you're covered.
Correct, correct, correct. It'll be understatement to say 2, 3 years I'll be covered.
Yeah.
So
And that's why, like, well, we understand there's uncertainty, but then if you're market ready and if you're ready to go, then this has uncertainty actually is opportunity, because
correct.
of course the sentiments, consumer sentiments are low, and
Yeah,
because of the market conditions. But then,
correct.
you're going and buying. I know, a couple of months back you bought in.
Yeah. Look again. Of course, you have helped me with number of investment properties. In building my portfolio. Once you are aware of what's going in the market, and none of these phase is permanent. When the interest rates were going down, they were not going to go down to zero and minus. They were not going to give you money out of the pocket. Banks were not going to do that. If it's gone up, it's not going to keep on going up forever. It's going to go up to a point, then it will start coming down. It will sustain at certain level. Then more economic things would happen. leading either the interest rates to move up or go down. There would always be something cyclic happening in that space. You need to, I mean, at least that you and I, we both are on the same page in that we have our own strategies and we are working towards it. Once we do allow for these things, we do look at what these mean for the decisions that we have made for for argument's sake. I know what I want to achieve in 2023 as far as my property journey is concerned. Right? You are very well aware of it. We had a number of discussions on those. Does the interest rates, inflation, uncertainty around the market bothers me? Yes, it does. It does bother me, right? But do I stop making my decision? No.
No, I think that's why you look at like all your mitigation plans and the cash flow
Mm,
management,
correct.
and then it's still like like so people again listening, we're talking about buying a property in Sydney as an owner occupied or in Melbourne, which Amit is in the process of negotiating. We are looking at a good discount, right? 5 to 7%. But at the other side, don't think that entire country is under and is negotiable. So on the other side, we're
Correct.
buying in Queensland or Adelaide or especially Perth market. You're talking about market is hot. Forget about
Yep.
negotiating. We are putting extra $10,000 to $20,000 on the asking
Yep.
price at
Yep.
the moment.
And
So when so every market is different. They're going through a different cycle. And Amit, you bought a couple of months back one in Perth, and that property has gone, I would say, at least 5% in.
definitely, definitely. I think we're looking at two doors to mine. It's advertised, sold, or under offer. The asking price was 80 grand above what we paid for. Um, and we don't know yet how much it has gone out for. It's under offer. The price hasn't been disclosed, but even if it's 60 grand, that just means mine's gone up 60 grand, I would imagine. So yeah, look, I think you're spot on. There's markets within markets, and to say blanket outright that a market, Australia, is going to correct 15-20% in a year, I think it's just advertising stand. I don't know what they're trying to achieve, other than readership. People negative news gets attention. Other than that, I don't think they're achieving anything.
Yeah, and it's not a correct statement anyway. So I think it's all false media, I would
Yeah,
say. And then,
yeah,
again, we're talking about the sentiments, like, like when the sentiments will improve towards the later part of the year, or as you said,
yeah.
maybe early next year in 24, then these market will be go further crazy, because then everyone is
Correct.
looking, hey, now I'm feeling good about buying a property, but then this property
Yeah,
would have gone maybe 10 to 15% up, and the
absolutely.
property we are talking about is a owner occupied in Sydney or Melbourne, then of
Yeah,
course forget about, again, you'll not have the negotiation power. So if
yeah.
someone is ready, I would say, yeah, just learn to dance with the fear and yeah, understand your numbers.
Look, and I think this is what I spoke in my last podcast as well. Get educated. Get yourself education is the key here. Whilst you're listening to everything, just decode it a little bit. Try to understand uh, how much of it is real and how much of it is, you know, just noise.
Yeah, true.
Once you get educated, just don't. At least you and I, we don't care what media is saying, to be honest, for that
It's
reason,
true. I
because
think,
we,
and that's what, like, I know, like, last towards the end of the year, also you bought one property. Right now it's what, early February we're talking about, and you're looking to buy and you're negotiating it, right? So I
yeah,
think, yeah, I think, and that's again a good way of putting it. Like, get educated, understand your strategy, the numbers, and once you understand, then you will be able to uh, you know convert that into an opportunity and able to take action. So I think
yeah.
I agree with you, Amit.
It it's a journey. It's not. People say I bought a property. Full stop. They stop thinking about. It's not. It's an ongoing, permanent journey you are on. You need to. If you are looking to build your wealth, then you need to keep going with it. You can't. It's not like when you have started a business. If you hit $50,000 in sale 1 year, whatever you're doing as a side business, you don't stop next year, do you?
Yeah,
keep going with it. You try to push for 75, 100, 200, half mil, and then people give up on their jobs, isn't it, Sanjeev?
True. I agree with
And
you.
it can
Yeah, I
go.
think Amit.
Isn't it?
And you know what? I think, and that's where it reminds also, like, what is your goal? Like, say, if your goal is to be a hey, really uh healthy and fit, then you don't look for that fine weather to do the exercise. You do it
Correct.
either it's winter or summer or rainy, right?
Yeah.
You go
You have to do it all 7 days a
all
week,
7 days a week, and that's where and property is no different, because you have to learn, understand what your goal is, and you do irrespective of, because opportunity is there. I can tell in the current market someone is making $1 million, multi-million dollar, so then why not you, me, or anyone actually? It's just a matter of educating and taking action. So
Yeah. Yeah, but I think interest rates are gonna play a massive role in a lot of people's life purely because of the pace at which people have been hit with. I think getting ready for it is the least you can do, so you don't have hard lending. And like you said, there are ample opportunities in investment, and get educated and learn from it, isn't it?
yeah.
And that's what we have been doing all the way through.
Yeah, true. I think overall, see, we have a good housing crisis all over Australia, actually. So
Yeah,
you go to we talk about any New South Wales regional, it's hot,
yeah,
stock low. Sydney, I mean, it's different story, because money is expensive. But then you talk
yeah.
about Adelaide, South Australia, or entire Perth
Mm.
or Queensland,
WA,
WA.
yeah, Queensland.
It's so I think ample of opportunities.
Yeah, yeah. And definitely, there's a lot. You have to understand the markets within markets. That blanket every property went up 10-15% was a one-off event, I would imagine. I don't believe that's ever going to happen again anytime soon.
Okay. No, Amit, I know, just conscious of your time. So now thanks again for your time today. But any final words for the investors in the current market, Amit?
Look, review your rates, do those 5 steps, and I'm sure that'll definitely help you out. Don't stop on your journey because there is uncertainty in interest rates. Get informed, make informed decisions, and keep working towards your bigger, broader goal rather than short-term fears and greeds kicking in. You become sophisticated investor when you grow out of those small-term fears and greeds.
Thanks, Amit. And what is the best way? I think I'm going to put all the details of your business and everything, but what is the best way if someone has to reach out to you, Amit?
Look, my number is there. I can put it out there as well, but it's there. It'll be there.
Yeah.
Sanjeev, just put it there. My email is there. Website is there. If somebody wants to look at what I do in that sense, yeah. So anybody feel they looking at starting their property journey and need accounting, finance, and overall strategy solution, definitely reach out to me at any point in time. That's our core in that sense.
Awesome. No, thanks again, Amit, and you have an awesome day.
You too. Thanks, Sanjay.
Thank you so much for tuning in today. Hope you enjoyed and learned something new from this episode. Please don't forget to review our podcast and tune in every Tuesday 8 a.m. Sydney time to listen to all our inspirational guests and learn from their property journey. In case you're looking for help with your property investment journey or building a property portfolio, please visit our website www.investorsdream.com.au to learn more about us and our services. And feel free to book a call from our website for a friendly chat. Have an awesome life and happy property investing.